4, 3, 2, 1. Buckle your seatbelts, batten down the hatches. Coming to you live from the Blazar Podcast Studios in Space City, Texas. It's time once again for the Capital Catalyst Show, the podcast for entrepreneurs to learn the secrets of attracting, raising, and closing capital from high net worth investors. Dedicated to your success, this is the Capital Catalyst Show. Now here's your host, Brad Blazar.
Hey listeners, welcome back. Brad Blazar here, and I want to welcome you again to the Capital Catalyst Show. It's the podcast where visionary founders and leaders, bold entrepreneurs share exactly how they've unlocked investor capital to scale their business, acquire a business, and literally take it to the next level. If you've ever dreamed of taking your idea, your company, your vision further than you thought possible, I want to tell you you're in the right place, because on each episode, we sit down with the trailblazers who've mastered the art of raising capital, whether it's from angel investors, accredited investors, small boutique RIAs, and family offices. You'll hear real life stories. You'll hear the triumphs, the setbacks, and all the strategies that turn these bold ideas into thriving business ventures. You see, folks, this isn't just about the money. It's about momentum. It's fueling your growth, building your future, and learning from those who have already walked that path and laid the foundation. So if you're ready to be inspired, if you're ready to get equipped and motivated to raise capital with confidence, hit the subscribe button now and listen up. The Capital Catalyst Show and every episode we do helps ignite your journey, learning how to attract, raise, and grow capital. So as I like to say, you can do something bigger in life. This is where capital meets courage and turns ideas into impact. Today's guest, I'm so excited, man. I couldn't even sleep this weekend because I've heard about old Gino Barbaro and the Jake and Gino show. And so today I am so excited to welcome Gino to the Capital Catalyst Show. Gino, how are you today?
Brad, I'm doing great. That was some intro, brother. I mean, fueling your growth, scaling your business. Those are things that I think people need to understand if they're to raise capital. People come in, and we were talking before we hit the record button.
Yes.
Do you want to raise capital? Are you actually even qualified to raise capital? Let's talk about that a little bit, because I think that's important, because I think everybody out there says, hey, I'm going to get into real estate and I'm going to raise capital. I mean, let's start talking about, do you know the business? Have you picked a niche? Do you know exactly what you're doing? These are things, Brad, that may seem obvious to us, but the people out there listening, hey, I can get money and I can use other people's money. Well, maybe we should take a little deeper dive into say, should you be even thinking about that before you even start investing in real estate?
That's a great idea. Let's talk about your background. Obviously, you and Jake, in real estate, fairly well known. Obviously, you've got a great following. But I totally agree, because what a lot of people don't understand and what they overlook is that when you take other people's money and they invest with you in a passive role, you're in the securities business now, yes, baby. You're not in real estate. Yes. You're not in capital raising. You're in a highly regulated space, not only with the SEC, but with regulators in each and every state. And if you don't understand the regulatory environment, boy, I'll tell you, that can be real expensive. No, I totally agree. So share with me a little bit about your background and why you feel so strongly about that very subject. Should you even raise capital?
Well, I started out in the restaurant business. I owned a restaurant for years until the 08 recession came, changed everything. I met my business partner, Jake. He was a pharmaceutical rep, taking orders out of the restaurant and going to doctors' offices and trying to sell them vaccines. He hated his job. I had no future in my current profession. Because remember, back in the 70s and 80s, you had a small business, you could make a really great middle-class living. Once the '08 came, you have technology, you have globalism, you have a crappy economy. All of that was going by the wayside. So I had to figure out, hey, let me get into this real estate thing and see how I can figure it out. I had made a ton of mistakes before I met Jake. So I was the one who went into mentorship. I was the one who had all the bruises. When I met Jake in '09, we decided to partner up. And I said, Jake, I don't really want to raise capital. I don't even know what that means. I want to do a couple of deals by myself, just me and you, to figure this business out, learn it. I'm afraid to take someone else's money, be their quote unquote financial fiduciary. And I like to learn and earn at the same time. That's how I can learn the business. Getting dirty, that was just my opinion of it. And obviously for me, it worked out really well. But there comes a point, Brad, when you do run out of money. And
Right.
around the 600 unit mark, we ran out of money. We had refied about 10 million bucks out of the portfolio. There's no more money left. So we're like, you know what? Now that we have buy right, finance right, manage right, now that we've gone full cycle in a
Mm.
few deals, now that we've got some experience, we have a business plan, let's start syndicating and raising money for deals to use as a stopgap.
I love that. I think that you touched on something that really resonates with me. Because so many people out there, they see all of the people that are on social media, whether it's you, whether it's Rod Cleef, whether it's Brad Sumrock, whether it's Hunter, and they say, oh, let me go out and raise a couple $100,000 and I'll do my first deal. Going from single family residential to multifamily is a big jump. It's not that challenging to manage 6 little units or, 8 little single families. But when you get into a 30 or 40 unit multifamily asset, that's where the headaches really start. Now,
Yes.
granted, there's economies of scale, but, I had a client actually that came to me that the first deal they did was a 40 unit property. And they realized as they got into it that they were in way over their heads. They should have started with maybe 8 to 12 doors. And then from there, the next deal, maybe 20. And then they could eventually progress up to a 30, 40, 50 unit property. So just like you said, and I totally think that's great, learn the business, learn on the money slope, for God's sake. Don't go down the expert black diamond, which a lot of people try to do. But I think that you really also touched on something that resonates with me. And that is, I always tell people this: raising money is the easy part. The hard work starts when you become a fiduciary and now have to be responsible to the money that you raised and a good steward of that capital. Because it only takes one disgruntled investor to really screw things up. You've been at this long enough, whether they contact a plaintiff's attorney or worse yet, go to a regulator, and boy, from there, a whole new world opens up that you're now trying to defend. And so nobody wants that. We always want to sleep well at night and teach the people that we work with in our communities how to do this and do this the right way. But what was your reason to get into real estate? When you met Jake, obviously, like you said, you were in the restaurant business. He was a pharmaceutical rep. What was it about real estate that was really appealing to you? Why real estate maybe, and not looking at another business or not doing something different?
It was a Friday night in probably end of January, beginning of February, when I had the restaurant. I was out in the parking lot. It was icy. There was snow. It was deserted. I'm out there cleaning the parking lot, throwing out salt. And I am alone. And I'm thinking to myself, I'm not making money. Again, another week that I'm not making money. My mom owned the building. And I look upstairs on the building. There's 3 apartments. And one of the lights was on in one of the apartments. And I said to myself, Mom's at home right now in her bed, and she's getting paid at the end of the month. She's making money at the end of the month. I'm not making money with this business at the end of the month. And it hit me right then and there. People who own real estate get paid in their sleep. That's the reality. And oh, by the way, her tax benefits were a lot better than mine. So it dawned on me. And then the reason why I love multifamily, it's a basic human need. It's food, clothing, and apartments. We can go into the demographics thing where people are renting more now than they used to. But that for me was the trigger. And I already had a full-time job. So I didn't want to go into single families. I didn't want to fix and flip. That was another job. That was more, capital I was going to earn as a W-2. So I said, how can I start? I had 4 kids at the time. I've got 6 children. I need to make some money on the side, working in real estate while I have my W-2/small business, give myself some kind of a runway where I can, continue to buy maybe 1 or 2 assets a year. So that by the end of 5 years, I have a couple hundred units so I can finally say goodbye to the job and say hello to the real estate full time. And one thing I'll say, Brad, if you're out there and you're listening to this and you're saying to yourself, I'm going to burn the ships, I'm going to go into real estate full time, I'm going to quit my job, I would personally advise against that or think about that, because when I started in 2011, I was making enough money to pay the bills for my house. All right, that's the money that I was making from the restaurant. It gave me 5 years of all the money that I made in real estate. I was able to put it back into the business. I wasn't able to live off of that. And I wasn't able to make these short-term decisions where, hey, I can buy this 20 unit, fix it up, and in 2 years, flip it and buy. No, I actually bought the 25 unit. We refinanced it. I kept the deal and I put my money into the next deal because I wasn't incumbent upon that money. And I wasn't looking just for fees. We didn't do
Mm.
we didn't do syndications, but if I was a syndicator at the time, I may have looked at deals and just said, hey, I need fees to live off of. I need fees. No, the fees you should be making should be going back into the business. You shouldn't be living off of those fees, especially early on when you're starting and ramping up the business.
That's a good point. I think that a lot of people don't really think that way. They take the fees, they go out, and they live off the fees.
Hmm.
They do the stupid stuff. They buy the fancy cars, they get a bigger house, they overextend
Yes.
themselves. And that's one of the worst things you can do, especially to the people that are new at this, because
Hmm.
every business, I don't care what business you're in, is cyclical. Multifamily
Yes.
cyclical, real estate in general cyclical. And there are going to be great times, and there are going to be times that you feel stressed and challenged, and you're going to love the fact that you were listening to Gino today. And as I like to say, put a little bit of money aside for a rainy day, reinvest it back in the business, build that cushion so that
Hmm.
you have 6 months, 9 months in savings to get yourself through those tough challenging times, rather than living month to month and looking at that fee revenue, as your primary source of income. Because, in the syndication or in the fund business, you can make money multiple ways. You can make money on the front end. We typically call that reimbursement of the offering and organizational costs just to bring your deal out to the public. Then there's the life cycle of the event, operating the business, providing management to the asset. And then, of course, on the back end is the waterfall. That's really the big payday. That's what we all, or the
Yes.
refinance, obviously, we
Hmm.
pulling cash out. As you and Jay kind of navigated, through this and built the business that it's ultimately become today, um, maybe for some of the people that are new to this, because I always believe if you can hear what mistakes others have made, you can hopefully avoid making those yourself and learn from that. What were some of the biggest mistakes you guys made along the way? And more importantly, how did you overcome them? What was the learning experience? Because I believe it's okay to fail and make mistakes, because each one you make is just a learning experience.
I made, honestly, Brad, most of my mistakes before I met Jake, because I always say there's life before Jake and life after Jake. And I had no map.
You're
I
gonna
had
tell the
no
listeners that Jake was the brains.
I don't know. I wouldn't go that far. I'm the one who made all these mistakes. And ironically enough, when we met, he was so hungry to do something else, but he had no real estate experience. I'm the one who went through the mentorships. I'm the one who spent the 50 G's to learn the business. I didn't know what a cap rate was. I didn't know what a cash on cash return was. I didn't know what DSCR was before I met him. But when I met him, I was ready. And the other thing that I
Yeah.
had
Who was your
that
mentor? Who did you learn from?
I learned from Dave Lindahl
Oh,
back
sure.
in
Yeah, Dave. Yeah.
'08. I mean, back in '08, he had phenomenal stuff back in '08. I mean, I,
Yeah.
I don't haven't followed him recently, but I was with Lindahl. I was with a gentleman named Craig Haskell, Value Hound. I think he passed away a few years ago, and
Mhm.
he was really instrumental in helping me understand that real estate and multifamily is a business. That's
Yes.
what people don't understand. They
Yes.
think of it, and the way I loved how you
Yeah.
segregated it out. Capital raising is one component of the business. It's a business in and of itself, right? That's the
Yeah.
important part. Because then you have asset management, which is part of it, and then you have the property management part of the business, where you're running the
Yes.
operations of the business, and then you have the acquisitions part of the business. So these are all different silos. When you start looking at it, it can become pretty complex. So you were saying like scaling up, and do you want to grow? Do you want to scale? You need to take these things into consideration and saying, what is your ultimate end goal with real estate? If it's time freedom and all that, well, doing what Jake and I did, it can be
Yeah.
really difficult for the next few years before you quote unquote get that time freedom. So understanding that. But getting back to your question, for me, a couple of biggest mistakes was I didn't have a process or map before Jake. Once I met him, we understood, hey, what is buy right? What does manage right and what does finance right look like that? And
Yeah.
you can look at any deal, any business, and if you can segment it into those three pillars, for instance, in the buy right, what are you buying? I mean, are you buying older properties? Are you buying newer properties? Are you buying a property that has a $50,000 median income or a $100,000 median income? Are you buying properties with nice amenities? Are you buying
Mhm.
properties that are townhomes? Really get crystal clear on the buy right. And it's important because when you're starting out, as most new investors, as myself, all we're looking for is, I want a deal. How many times have you heard that? Well, what is a deal to Brad and what's a deal to Gino? They're two different components. Brad's got more
Sure.
money than Gino. Brad's got more experience than Gino. Brad's got more investors than Gino. So a deal for Brad is going to be a lot different than a deal for Gino.
Mm,
Taking that buy right's important, but I think the component that most people make a mistake on is the manage right, is the systems, the
right.
processes that go into running that business. And I think for us learning early on, we had our own property management company day one. Jake managed the properties day one. Now, most people are going to say, you're nuts. But like I said, the pizza guy and the drug rep, we ain't that smart. We needed to learn and figure out ourselves. And once we started scaling it, Jake was able to leave his job. He became management full time, started hiring people out, and that's how he grew the business. But for us, really looking at those three pillars and looking at every single deal based on those three pillars. If one of those pillars is weak, like bridge debt with financing, well, what happens? Bad deal. Buy right,
Right.
oh, you overpaid, wrong part of the neighborhood, bad deal. Oh, you don't know, you don't have any KPIs, you're not managing this property properly, bad problem. So if you're looking at it from those three pillars and trying to limit your downside, as the great Donald Trump would say, the upside is going to be taken care of.
Yeah,
You
yeah,
know?
yeah, absolutely. So let's shift a little bit. You guys started obviously with your own capital, which I think is great. Learn the business, put the systems in place, make sure you have the foundation. Because I always believe that when you're talking to investors, especially sophisticated investors, people that have been around the block a couple times, it's like they got a checklist. They want to look at Jake and Gino and say, okay, can I check the box on these things? Investor relations, yeah, I think they get that check. What about accounting infrastructure? Yeah, I know that they got a little accounting relationship. I'm gonna get my K1 compliance and understanding of the regulatory environment. They kind of go around the clock to make
Mm-hmm.
sure that you guys understand the business. But once you started raising capital, how did you begin the process? Was it family and friends? Did you host local events there, where you guys lived and invite accredited investors to a upscale venue? There's so many different ways to raise capital. What worked for you guys?
Well, even before I started raising capital, I still needed someone with a balance sheet. I wasn't Gino, the liquidity person. I didn't have that much money. And for me, after that first deal, it was a real quick, easy, real hard transition in my life. I'm getting audited by New York State. The market sucks. I'm making less money. I'm stressed out, but we had just bought a great deal. I'm like,
Mm,
I really need to lean into this. And I'm at the restaurant one day, sitting down in the front, and in walks my partner today. His name is Mike. He sits down next to me. I've got like these pizza stains on my shirt, and he starts talking about China. He starts talking about India and gold
wow.
and inflation. And I was able to reciprocate. And he was pretty shocked, to be completely honest with you. He had his nice Bruno Mai shoes on. He looked like the hedge fund trader that he is. And
Mm,
I looked like the guy washing dishes. But then I started talking about real estate. And I said, Mike, we just bought a deal. We paid 25 a door for this thing, $600,000. Rents are 13,000 bucks a month.
wow.
That's like we're buying it at a 4.5 times gross rent multiplier. Mike, what are you doing? He's like, well, you know what? I'm in the hedge fund thing, but I just bought a $2 million single family. I'm only getting 10 grand a month. It
Mm,
doesn't take a rocket scientist to see that I've got a great deal, and he doesn't. He says,
yeah,
tell me more. I'm like, Mike, when I find another deal, do you mind if I share it with you? Well, he said, sure. He walked out the restaurant. 30 days later, we got our second deal. I'm like, Mike, are you willing to invest with us? It was a 36 unit deal. He invested on that deal. Great.
right.
That second deal led to our third deal, which was 136 units. It was $4,050,000. Now, Jake and
Wow.
I were tapped out. We scratched out everything we possibly could. But Mike, who had the liquidity, who had the balance sheet, who
Mhm.
literally lent us $500,000 as part of the down payment, then we paid him back when we were refinanced. It was like, oh, wow. And I guess the whole point to the story is you need to be talking to everybody you possibly can about
Yeah,
what you're doing because
yeah.
they think of Gino and they saw Gino at the time as the pizza guy. And a lot of people still do. But I needed to tell Mike and I needed to tell everybody out there that I was in real estate and I was looking at deals. And I'm going to be honest, Brad, if I hadn't met Mike that day, I don't know how I would have proceeded because I still needed somebody with that balance sheet. And Mike, along the way, mentored us. He taught us more about the business of not only just real estate, of numbers, of operating income,
Sure.
expenses.
Yeah.
And then from there, we just started getting the word out. We decided to write a book in
Wow.
2016, 5 years after. We started a podcast because, hey, let's start a podcast. Let's start talking about it. And I think the key to capital raising, as far as I'm concerned, is they're not just investing in the deal, they're investing in you as the sponsor. They're investing in somebody who's passionate about what they do, who really to me, is really being transparent, authentic, honest, loves what they're doing, is going to put the investor first, is going to be communicative first. If you can have all of those qualities, it's not going to be, in my opinion, hard to start raising capital. But you really need to, as far as I'm concerned, you really need to be an expert. You really need to know what you're talking about with real estate. And for me to raise capital, it's buy right, manage right, finance right. This is what I've done. I'd love to have you on this deal. That's probably it in a nutshell for us as far as raising capital. Get out there and amplify your message as much as you possibly can, and let as many people know what you're doing, because you're going to get a lot of no's. They're not saying no to you. They're just saying no to your offer. But you
Yeah,
will get the
right.
occasional Mike that sits down next to you that has a bunch of money and goes, wow, I like that proposition.
Mm-hmm. Yeah, I mean, I think that you hit the nail on the head. It's, it's being out there, it's communicating, it's basically pressing flesh, going to meetups. I was
Yes.
talking to a guy the other day. It's really interesting. He just signed on. He's going to be joining our community, and he said, "I'm really frustrated. This guy's got like 2,000 doors, so he's been at it a while. He's very successful." But he said, my capital is run out. I'm dry, and I need a
Yes.
new source of capital. And I said, "Well, tell me what you've been doing." He said, "Well, I've been going to all these multifamily meetups, And I'm like, "Well, that's the mistake." You're
Yeah.
going to a multifamily meetup. You got new people there trying to learn
Yes.
the business. You got a bunch of other people that are just like you that are looking for capital. I'm like, "You're in the wrong damn room." I said, "You need to be in rooms that I go to where you walk in the room, maybe there's 10 presenters and the other 60 people are who? Family offices, small boutique registered investment
Yes.
advisors looking for quality deals, ultra high net worth investors. Can you see the difference in the two
Ah,
rooms?" He said,
huge.
"Yeah." So I said, "Well, come with me next week. I'm going to be at an event in Dallas and I'm going up to New York. And then the next week I'll be at a couple more of these events. And this is how you get the proximity to, this audience of people that can potentially be investors." The question I wanted to ask you with Mike, obviously as one of your original, first investors, through him, were there introductions or referrals to other people in his network?
There could have been, and we never went down that route because me, Mike, and Jake, we were just partners up along the
Okay.
whole way. We decided let's keep reinvesting
Just keep going.
keep refi, and then when we did get to that very first syndication, it was like okay, and it was very interesting. We'd never done a syndication before. We found a great deal in 2018. We had to raise $2.5 million. We did it in 48 hours. It was pretty simple.
That's
By that
right.
time, we had already done one live event. We had already built up a list. People were already following us, and when we got this offer, this deal, it was like, okay, let's put it out there. Let's
Yep.
put a webinar out there. We had done a couple of events. We went on Bigger Pockets. So people had already started
Sure. Yep.
following us. And it's like, oh, wow, here's the deal. Do you want to invest in it? It wasn't a hard sell. It was one of those things where you have to make it, I guess, entertaining and educational.
Right.
Multifamily, honestly, Brad, it's pretty friggin' boring. I mean, like, people focus on IRR, and a lot of these people don't understand you have to make it simple for a doctor or a lawyer. And I would add one thing to your what you were saying about getting in the right rooms. Look, if you're a doctor, let's say you're getting into this business and you speak any kind of lingo. Like I was in the restaurant business. So I was very good at speaking to people who had small businesses. That's
Mhm.
people who resonate with me. So if you're starting out by raising capital,
Yeah.
speak the lingo. If you're a salesperson and you really resonate really well with those salespeople, same like Jake. Jake was a pharmaceutical rep. You know how many people who joined our community just because they loved his story and they could resonate with him? So if you're out there and
Wow.
looking to raise capital, speak the lingo. I mean, focus on one avatar. Don't throw this big wide net early on. Try to
Mm.
focus on people that you're trying to serve and let them know why you're doing it. I think that's important as well, Brad.
I think you hit the nail on the head. I always tell people there are riches and niches. And, if
Yes.
you're a doctor, raise capital with physicians. They can relate to you, you can relate to them. For you, it was small business owners. Obviously, for Jake, it was people that were sales professionals. And there's a lot of
Hmm.
people out there that, of course, make a lot of money as professional salespeople. But, the interesting thing that's kind of coming full circle here in our talk today is I believe that there's actually three types of capital out there. There's the money that we're all chasing, right?
Hmm. Hmm.
The second type, which is huge, which unfortunately for a lot of people is not something that they tap into, is relationship capital. Like,
Yes.
once you get an investor on board and you're proving your worth to them through the distributions, maybe they've gone full cycle. It's going back to that affluent individual because typically rich, wealthy people know other rich, wealthy people. I've never seen Richard Branson hanging out with bums under the palm trees there in Necker Island. He's got celebrities and he's got big time people. But it's the relationship capital where you go to your investors and you ask for referrals. But I think that a lot of people do it the wrong way. They say, hey, Jake, do you know anybody? Or hey, Gino, do you know anybody that might want to invest with us? And of course, the answer many times is no, because it's a question that just shuts down the mind rather than expands it. And so I just kind of turn it around and I say, hey, Gino, who are you connected with that I should also be speaking to?
Ah, I love that.
You see the difference
Yes.
in the words, but now you're like, man, I got this guy, Mike, he just sold his business. Or, hey, I got a buddy of mine that I go golfing with every Tuesday, and I think he's got some money. He might be liquid. And then, of course, you follow that up with, would you mind making an introduction either through an email and or a text? The other one, though, is huge. And this is the one that I think a lot of people overlook. I always say when you're talking to people that got big time money, and I'm talking big time, you don't pitch first. You don't even talk about the deal. You lead with value.
Mm-hmm.
You find out what they're working on or what they need help with, and you see if you can help them before you even really talk about the need for capital. But the third capital is intellectual capital. You see, if I'm talking to an investor and he tells me that he made his fortune in what? Real estate, would I not want to maybe invite him to be an advisor to my company?
Yes.
Or say, hey, Gino, man, I'd love to have you on my board of directors, man. Your knowledge, your experience is so valuable. How would you like a seat on my board? And then when you're over here on my board, then we can talk about your network and how you can benefit me. And I know that behind you, there's much more capital.
Yes.
Because of the relationships you've cultivated in, quote, building your business. And so for the listeners, that is a golden nugget today on this episode. 3 types of capital. Be thinking about all 3 at all times. Quit chasing the money, which I know we all need and we all love to do, but also be asking your investors once you start cultivating that database, who they're connected with, that you should also be talking to. And to the big time investors that maybe have created their success in a similar business or perhaps the same business, invite them to be an advisor. Invite them to your board. Those are the 3 types of capital that I believe we should all consistently be thinking about. One thing that I want to always focus on, which I think is real important, is kind of that work-life balance, right? It's so hard, especially in the earlier years. You're hustling, you're going. How do you and Jake really prioritize kind of what I call that self-care, the mental health, the aspects of being a whole person? Because, I'm a big follower of Stephen Covey and, I've read some of his books. He talks about this thing, the whole person theory, where we're kind of made up of 4 elements, our mind, body, spirit, and soul. It's real hard, of course, when you're hustling and you're going to focus on the other elements of your life. You got 6 kids, of course. But how do you balance that in terms of your self-care, your mental health, and also, of course, being a successful entrepreneur?
I had one of my mentors say to me years ago, he lived by what he called values-based decision making. And I didn't understand it at the time. I'm like, okay, what is that? What does that mean? Unfortunately, his name was Rick Sapio. He passed away last year. But to me, it really struck a chord because we're all making decisions based upon our values. We just don't know it. And when we really live in alignment with our values, for example, when I was at the restaurant, I didn't hate the restaurant so much that it wasn't making me money. That was obviously one of the elements, but it was started going against my values. And my values at the time were family. I had to work on the weekends. I had to work every holiday. And that was killing me. And I didn't understand why. It was in direct conflict with my values. So today, like yesterday, I went to the Jacksonville Jaguars game. The whole family went. You know what I mean? Like we all went. I can't spend every weekend out on the golf course and I can't go out every night with my friends partying because I have a family. So there's a lot of things that I have to say no to. They don't align with my values. Would I rather be hanging out watching Netflix sometimes? Absolutely. But you know what? At 8:30 at night, I've got a 14-year-old who wants to read Harry Potter. So I'm going to sit down and do Harry Potter with her at 8:30. I'm going to read half an hour. I'd love to be able to spend time for myself. So I think every decision that you're listening to right now, you need to make based upon what your values are. And most people don't even know what they are. They're just making decisions on the fly. And every decision needs to be scrutinized, whether you're in what, first of all, you talk about data storage. before when we got on. I don't
Yeah.
even know what that is. That does not excite me at all. I would never even want to look at that. So it doesn't align with my values, right? I just can't see myself investing in that. That's great for Brad. Somebody on here may say multifamily is so boring. I would never do it. Their values maybe are just they want more risk, they want more excitement. So go into the
Yeah.
crypto space. I'm not here to tell you what's good or what's not good. I'm here to tell you what's worked for me. But then you have to understand what your values are. And every decision, hiring a vendor, hiring an employee, going on vacation, where are you going out to eat? What does the schedule look like? Even the sports you're playing. I unfortunately could never play golf because golf is a weekend activity. I go to church on Sundays. I need to spend time on the weekends with my kids. I'm quitting the restaurant, but then I'm going to go into real estate and I'm going to hang out every weekend on the golf course and not spend time with the family. Do you see how that goes in a total misalignment? So
Right.
I think that's really important. Getting back to what your values are, understanding what they are, and trying to live by them. I mean, it can be challenging. It's hard. You
Mm.
have to say no to a lot of things. But
Yeah.
I mean, if you're saying yes to the right things and the things that align with your values, not only are you going to be more successful, I think it's going to lead to a much happier life as well.
Yeah, I mean, I think it gets back to kind of another question that I often talk about, which is, do you have any mantras or do you have any philosophies in life that you subscribe or live to? And I think you just kind of answer that indirectly. It's, family first, obviously, but it's having that, that life work balance that
Hmm.
I think for a lot of people is really hard to get to because, you have to learn to say no. And so many people hate doing that. We're all in the business of trying to please other people. That's what business is about. It's pleasing the customer. And, you mentioned earlier that even real estate is truly a business. It is. You got to keep your customers happy. If you got a bunch of
Hmm.
customers that are tenants and they're pissed off, you're going to have a lot of very, very unhealthy people. And of course, that's just going to come back on you. It's going to come back on the reviews of the property. If your property's getting reviews, and of course, that's going to affect you negatively. So all these things, listeners, do have a big compounding effect. And it's really important, I think, also to understand why you're doing what it is you're
Yes.
doing.
Hmm.
We kind of heard a little bit about Gino's backstory about, working in the restaurant, wanting more freedom and looking at real estate as kind of that vehicle. But, you guys have been successful. When you started the Jake and Gino show, did you think it would have the impact it's had on the business? Have you seen that it's obviously helped you raise more capital, get in front of a much larger audience? How have you been able to leverage the show to build the business to a much greater business than if you had not had one?
What's incredible about it is you think about the KPIs, the key performance indicators of the podcast, how many students we've enrolled, how many
Mm-hmm.
downloads we have, how much capital we've raised. When in reality, we've been doing it for 10 years. So I'm probably going to say we've done over 500 shows.
Yeah.
For me, it's been my university. It's been my
Mm.
weekly mastermind. And I'm not going to downplay that. I've spoken to T. Harv Eker,
Yeah.
G. Edward Griffin twice, Robert Kiyosaki.
Yeah.
I've had the chicken soup guy. I've had Sharon Lecter. I've had dozens of people that if I had to go out and shell money to get them to speak for an hour, it would have cost me hundreds and
Sure.
hundreds of thousands of dollars. But then I've also had people, operators like you, Brad. I've had people in the business, people who have scaled companies, people who've been entrepreneurs, thought leaders, things that I've learned over those 500 plus shows that there's no way I would have been able to learn. It's made me such a much better investor. First of all, that's the first thing. I think you cannot discount that. Start a podcast, start talking to other people. And like you said, the network and the people that you meet after the shows is like, wow, can you introduce me to cost segregation person? Who are you using for your syndication attorney? Who's your CPA? Those questions while you're on a show or after a show are incredible. But to your point specifically, as far as the branding goes, Brad, brokers like to talk to people. They like to talk to Jake and Gino. And they've seen Jake and Gino. Like, I want to do a deal with Jake and Gino. We closed the deal
I
last
love it.
year
I
because a
love it.
broker wants it. And then we love to interview brokers. So let's amplify their message. Let's create a win-win by getting them on the show and let's have them bring more deal flow to us. And it's really
Mm.
ultimately, I think people need to understand this. And I think most people don't realize that every single person out there is their own brand.
Yes.
We are our own
Yeah.
unique brands. Whether you want to be a Ryan Serhant who sells luxury office and residential in New York and wherever, or you just want to be the pizza guy and the drug rep who are just raising capital for multifamily deals. Whatever that is, you can create your own unique brand. You can create your own unique image. The whole thing. And I think the podcast and the book that we wrote, and the platform that we created, that's all helped us to be able to amplify the message and is be able to help us to scale our portfolio.
You know, you reminded me of a conversation I had not too long ago with a good friend of mine that's been in my corner, and he was a coach to me very early when I was getting started. My good friend out of Nashville, Coach Michael Burt, and he said, "You got to realize," he said, "you're not in business." He said, "You're in show business."
Yes.
The more attention you can call to yourself and your brand through everything you do,
Yes.
the bigger you can build your business. And it's
Yes.
really all about visibility. It's, getting on the stages, it's getting on the shows, it's being interviewed on the radio, being on television. And, getting all of that just kind of compounds and it just continues to grow. And that's what creates, as I call it, social influence. That's where you become a person of interest. That's where investors are going to actually be chasing you, saying, "Hey, I heard you on the
Yes.
Mike and Gino show, or I heard you on so and so's podcast talking about what it is you're doing. I like to get some more information." And it actually gets to a point, listeners, where the ability to start getting in front of investors is not nearly as challenging as it is when you're starting out, because what you're doing is you're leveraging the tremendous power that social media allows us to leverage. That's why today, if you start scrolling through, whether it's Facebook or Meta or, Instagram, LinkedIn, you see all these people out there with their deals,
Yes.
doing podcasts, doing webinars, educating people, and then taking that interest and moving people forward through a proven process to a logical outcome. They're either investing with you or they're not. And if they're not, like Gino said, doesn't mean that they don't like the deal or they don't like you. Maybe the timing's not right. So you trip on them for a couple months and then they finally come into some money. And before you know it, they're an investor of yours. The whole drip process in raising capital is a very important other element, that we haven't talked about yet as well. I absolutely love that. Well, as we kind of wrap up, and get to the top of the hour, what legacy, are you trying to leave behind? Are any of your children showing interest in the real estate business? Do they, even better yet, work in the business alongside you at this point?
That's just one of my favorite questions because I just wrote a book called Happy Money, Happy Family, Happy Legacy. And I interviewed a gentleman named Ken Honda from the podcast. He is the guru of happy money. He's the Japanese guru out there in Asia. He sold 8 million copies. And on the podcast, in his Japanese little dialect, he said, "You need to write happy money, happy properties, happy legacy." And I'm like, I don't want to write another real estate book. I want to write a book that really highlights a person's relationship with money. But just as important, why are we making all this money? What does legacy actually look like? Once again, it's based upon a person's values. So for me, it was all about, I wanted my children to have really healthy relationships with money. I didn't want them just to become financial stewards of the next generation where I'm just handing over a bunch of money. I wanted them to actually understand what our values are, and they do, and bringing it over to the next generation. And 26-year-old daughter, she's in 3 of my deals. I have my son who's 23. He's invested in 9 of my deals with his own money. He's a 23-year-old whose tax return was 50 pages long. So okay, if you can imagine, and it's not one of those things where here I gave him money. He was 15 years old. He was gonna buy an amplifier. I remember he had $5,000 in the bank. I said, "Mike, I'm not going to allow you to buy the $1,200 amp because you don't need it." Make a long story short. He said, "Okay, Dad." I said, "When you get a deal, can I invest in your deal?" And that was 8 years ago. That $5,000 investment has turned into a 7-figure net worth. Applying, refining, rolling, buy more deals, and that was the beauty of that. So for anybody out there, I think having that conversation about money with your children is so important, starting at an early age and finding out what your relationship with money is and being transparent and honest. I had a tough time with money early on, and I can see the difference and the trauma that it caused my older kids versus my younger kids. So the legacy that I'd like to leave my children is money's important. Money is not everything. Money is a tool. Money is a result. And money is the result of creating value. And the more value and the more problems that you can solve in life, the more money that you can more money that you can make. And I'd also like to tell them, if there's no margin, then there's no mission. Don't be on your high horse by saying, hey, I'm not doing this for money. We need to make money to be able to continue with the mission that we have. And it's the same thing in real estate. If you don't got the money, then you can't do the deal. You can't serve the investors. You can't serve your employees, and you can't serve the residents. So looking at money from that perspective shifts a lot.
I love that. You know, I believe that you're never too young to get started. I keep hearing age as an excuse from people in their 20s. Personally, I started raising capital while I was in college at the age of 21. Went to work for a small oil company. The CEO took me in under his wing, was going in between classes after school.
That's awesome.
Correlate that into a business myself. But, you know, it reminds me, I was a speaker at an event about 2 years ago in Atlanta. And the organizer, the host of the event, wanted to call recognition to a young man in the room. And he said, I'm looking for a guy that I know is here. Abbas, where are you? And, you know, this little kind of Middle Eastern guy stands up. He said, how old are you? And I think the kid was about 26, 27. He said, tell the group here how much real estate you and your company currently has in its portfolio. This is about $40 million. This kid's in his 20s.
Yeah.
And I'm going, holy crap. He reminds me of myself back when I had my energy company.
Yes.
And, you know, he said, look, you know, to me, age is just a figment of the imagination. He said, you know, my investors don't really care that I'm in my 20s. And it's because I put together my team. You know, it's not just me doing everything. I got a CPA, I got an attorney, I got people that take care of the assets. And so I'm able to tell our investors that, you know, we bring collectively, whatever, 75, 100 years of experience to the business. And I'm just kind of like the composer. And so I went up and I introduced him. And of course, we became pretty good friends over the years. But it just goes to show you that, you know, you can get started, listeners, in your 20s. You know, you don't have to have the gray hair. You don't have to be, you know, in your 30s and 40s with the limiting belief that, oh, I need to be older because I'm talking to investors that are older. No, you know, they respect hustlers. They respect people on the go, and build your fortune now. I mean, I know a lot of people that are in their 30s that no longer have to work. They choose to because they're passionate and they love what they're doing and they're building a legacy. They're impacting lives. They're very philanthropic. So they're serving a much bigger purpose at this point in their life than just themselves and their family, right?
Yes.
And I think it really comes down to what you said. What are your values? Who do you want to serve? Because once you get to a certain point financially, the whole philanthropic side to you can easily open up. Now you continue to grow. You continue to build, not for you and your family, but now to help others. You know, it could be your alma mater, it could be a medical institute that you want to donate capital to for whatever, cancer, et cetera. So, you know, guys, keep going out there, listeners, and just keep realizing that you should never stop. You should always grow. And I think that's one of the great things about being an entrepreneur. It's just keep growing and keep realizing there's always going to be another level that you can be playing at. When you think you're playing at a big level, let me tell you, there's always somebody playing at a bigger. You know, it's kind of like pulling up that big yacht down in Nassau in the Bahamas, and then you look to your right and your left, and you're like, shit, this little baby's a Boston whaler next to these guys. You know, you know, this has been great. How do people connect with you and follow you if they want to learn more about what you guys are doing, or, you know, really get some information maybe on one of your deals, or perhaps, you know, some training on the multifamily space? We train much more on the capital raising, but if they want to reach out and connect with you, what's the best way?
Just go to jakeandgino.com. That's the website for the multifamily. And my family company, it's barbaro360.com. That's my last name, barbaro360.com. You want to learn about money, your relationship with money, get a free copy of the Happy Money book, just go to the website. You can download a free copy there.
Fantastic. And where's home for you nowadays?
St. Augustine, Florida, one of the best
beautiful
places in the United States. It is just amazing. I'm a transplanted New Yorker. Left 8 years ago. I came down here, and talk about timing. Timing was pretty good on that one, Brad. I'm not going to lie to you.
Yeah, St. Augustine is a beautiful, great place. I connected many years with Joe Namath through a mutual friend. He's down there in your neck of the woods. So listeners, if you ever get down to St. Augustine, reach out to Gino, who'll whip
I'm here.
pizza, and you'll be able to share great pizza and a glass of wine. It's been a pleasure hosting you on the show. Listeners, like I said earlier, if you're not an active subscriber and you've enjoyed this episode, click that little button, become an active subscriber. Better yet, leave us a review of this episode and prior episodes. It's Brad Blazar saying once again, live life big. And thanks again for listening to the Capital Catalyst Show.
You've been listening to the Capital Catalyst Show with Brad Blazar, the best place for entrepreneurs interested in doing something big in life, having considerably less stress, and a more balanced life. Go to bradblazar.com for more ways to accelerate your success.